Hey, how you guys doing? We are viewing right now. I'm mumbling words right now. Don't worry, this is the fourth or fifth episode. I'm gonna get it together one day.
We're back, yeah.
We're back. All right, so Dumb Money, Smart Moves. Like I said before in all the other episodes, we're looking to help people make smarter moves with their money, and we're called Dumb Money according to the institutional investors, and where we're looked down upon because they feel they're just smarter than us, and we're looking to make better moves with our money. So in our last episode, we spoke about insurance, life insurance policies, and how we can build wealth. And this is the part that I love. How can we make money off of these policies? A lot of times we don't understand that we can use these policies to generate some sort of wealth. And we're going to kind of give you the hustle thing behind it. So I'm the hustler, and this is the smart professional dude. So I'm the hustler dude, and we're going to try to figure out how to make this money off this insurance policy, and also have insurance policies because we need it for our families. So that's the most important thing. But in the meantime, we're going to break down how we can use these policies in order to get something off of it. So let's
build
go
and
into
preserve wealth. So
all right. So let's get into it real fast. So we have term and we have whole life insurance policies. So correct me if I'm wrong with term. Just tell me if I'm wrong. Term life, we don't get any face values for anything. There's no cash value.
Yeah, generally there's no. It's just strictly protection of insurance.
It's just protection insurance. We can't borrow against it. We can't do nothing about it. It's just if you expire, your family has something that they can use to bury you with within that time period before it expires. Okay, so we got that part. Now let's go to what you and me need to get. Let's get this part. Whole life insurance. So that's where our hustle is going to come from. Whole life insurance. So whole life insurance. You explained to us that there's probably a few different type of whole life insurances. So explain to us about I guess it's the cash value or face value. Is it called a cash value?
Yeah, so there's a cash value that you build up based on your annual premium or your monthly premiums, and plus the interest.
Okay.
And then there's a death benefit portion that's also tied into it. So the main difference is if you want a fixed level death benefit, or an increasing death benefit. And basically what the difference is, like for example, if you have a whole life policy and it's a level death benefit of $100,000, right?
Okay.
And you put $40,000 in it, like your whole life.
Okay,
right?
so I'm gonna slow it down for people like me.
Yeah.
So we have $1,000.
$100,000 for the death benefit.
For the death benefit. So if you
if
pass
away next week, they're going to issue
$100 grand. All right, cool. Yeah. All right, so you got that part.
Yeah.
Go ahead, because I'm still going to ask you other questions. I'm sorry, I don't mean to interrupt you, but I want to make sure that they understand, like people understand the questions that somebody like me will ask, so that while you're explaining, and I don't mean to cut you off, I don't want to cut off.
Now go ahead, because I'll keep going. Like so,
because you're good with it. You're good with it. I get it. I get it. I'm sorry, guys. I'm actually checking my phone too because we have somebody else coming in or whatever. So here we go. He's gonna take over for a few seconds, and I'm gonna take this call real fast. See, this is how we do it. So we're real. There's nothing planned.
Yeah,
we don't practice and do it. We just go right into it. So I'm gonna take a call real fast because we have somebody else coming in. But explain to them about the investment vehicle, the whole life, and how we can get money off of it. Well, not how we can get money off of it, but the whole face value and all that other stuff. I'll be right back.
So like I was saying, like if you start with $100,000 for your death benefit, and you're contributing to the policy, and you contributed, let's say, $40,000 out of 5 years or what have you, that money is going to be more than $40,000 as far as the cash value, because it's accumulating interest every year. So let's say 10 years down the road, that $40,000 turns into $80,000. So right from there, that $100,000 policy that initially started is now worth $180,000. But the difference is, what happens is, when you pass away, you're not going to get, your family's not going to get the 180,000. They're going to get the 140,000, and that's because the insurance takes the parts of the money that actually accumulated interest. So some people are like, wow, how come I can't get the whole thing? That's just some of the different risks. If you want something where a policy where you're going to get everything that you put in with the interest plus the death benefit, then you might want to go and look towards IUL, which is going to give you your interest, everything that you put in it as far as the cash, as well as the death benefit. But there's pros and cons to it, where it's going to depend on your situation of, do you want something that's more conservative, or are you in a position where you want to take on more risk?
Okay. Yeah. I'm going to get to the part for all of us. I'm sorry, I didn't mean to interrupt or whatever. We have somebody else coming in. But let's get to the part about what's better for us, about the money part and how to use it in order to do certain things. So let's talk about the IULs. So the IULs, as he's saying, is connected to the market. And if you're watching the market on a regular basis, if I may have the number incorrect, so excuse me, but I may have the number incorrect, but the S&P 500, let's just say the market in general, gives you about, I think it's anywhere between 8 and 12% back on your money, just as a regular rate. You can expect, if you have good stocks, you could expect about an 8 to 12% return on your money. So now if you're talking about getting an insurance policy, and that policy, that benefit is for $100,000,
yep,
and you're putting in whatever that money is, trying to get to whatever that policy number is, you can also, and you could explain this to me, can you borrow against that money? But wait, hold on. Let me add this. So that means, hold on, I'm so sorry. Yep. I'm getting hype right now. I'm sorry. Let me calm myself down. So that means
the good part. Yeah.
The money is growing besides what you're putting in there. So if I'm paying $150 a month,
yep.
So if the market is going up, that policy is gaining more value, cash value yep. on top of it, is gaining more cash value, and with that cash value, that just, so $100,000 policy can actually be, I'm just saying, if you take the $100,000 policy and you multiply it by how many years that you have been put into it, so you put 10 years. So if you average a return around, I'm not doing the math right now. I ain't good with that.
Yeah. Let's just say 10%.
10%. You know? So if you did 10% for 10 years, that's 10% added on each year to that value of that policy. So your $100,000 policy becomes X, Y, and Z dollars. I'm not doing the math. Yeah. But it becomes worth more, and you didn't actually put in more. It's just worth more.
It's just, because it's tied to market. Interest. Yeah, you earn interest on that money that's tied to the market. But there is a cap level. So like I think right now the S&P this year is I think up 21%, some give or take.
Okay.
We up 21%. But for the policies, they're not going to give you all of that. So there's a cap to it. So like your policy might be capped at 8% or 10%. So if it goes to 21, the insurance is going to take whatever's extra, and they're going to give you the 8%. I know that may not sound really good, but I mean it's better.
You're right. But
let me explain the other side. So
go ahead.
For them being able to make sure they can pay everybody and they stay whole and they don't go out of business, when the market is actually down, there's a floor of 0%. So let's just say if next year we go into recession and the S&P is down 15%. And you're still contributing, you're not going to lose money. So it's going to be level. It's going to be zero. You're not going to get anything for that year.
Okay.
But at least you're not going to take a loss. So, obviously, if we invest in the stock market, if we're not diligent about our investments, there's a possibility of loss.
Okay.
With this, on bad years, you don't lose anything. But there is also something that's called the cost of insurance.
Of course, if you done
Yeah.
hit me with something else. All right.
Yeah.
So I actually got to get the guest. I'm sorry. I actually got. It's not even a guest. I'm so sorry. She's actually the host. Yeah, she's the host. So we're gonna change up the setup just a little bit. In 2 seconds. We're gonna continue on this episode. We usually go. Just to let you guys know, we usually go straight through with everything. There's no pausing. We don't do too much editing. What you hear is what you get. So if you hear us make mistakes, we're just real with it. We're not trying to be pretty or cute with it. So we just go straight into it. Yeah, straight authentic. So if you want to go on while I go get this person, then you could go on. But I'm going to ask you for them or whatever. I'm going to ask you for them. So the part about the using it as an investment vehicle. Now, when you look at the IUL as an investment vehicle, what are some of the ways that we can use to borrow against it? How do we pay it back? So I'm going to ask a few questions for you guys. How do we pay it back? Yeah, you can start off with that. How do you pay it back? Is it a good idea to do it also? Like go into some of those things with them or whatever. And I'm going to be right back. You're in good hands with him, so I could go and come back. I'll be right back.
Yeah, you might be missing out on the good part.
I am. Hey, I'm going to watch it again. I'm getting all this. I'm about to start taking some notes.
Definitely.
This is the money part.
Yeah.
Listen in. I'll be right back. Thank you, Will.
So like Paul was saying, can you borrow against it? And you absolutely can. I think after a while, when you put enough cash into it and you have a nice cash accumulation in the policy, you can borrow against it. Let's say if you put like 60,000 of your own money and it grew to like 160, for example, and you want to borrow like 50,000, you could take a loan out against that insurance policy, whether you want to go and put down on real estate, whether you want to go put down on buy a car, or you need extra money to buy a business and you have a partner that, hey, let's go and, put down on a laundromat or whatever. You can take that money out of the policy, but what's really important is that you don't make a regular withdrawal. You tell the insurance carrier that, hey, I want to take a loan out of the policy, and they may charge you maybe somewhere roughly between 5%. It's usually dependent on the insurance carrier or what is the actual interest rates that's right now. And you just got to say, hey, if I take this out, could I make more based on the money that I take out than what is actually going to go back in? So if you're buying an investment vehicle, then most likely you're going to make more than 5%. So when you get that money back from whatever your investment is, you just put the money back in there. And which is really cool about this, which I love, right? So now you really didn't really miss the good part. So you came back just in time.
Just in time. Yeah. I like the good part, the money part. Let's go.
When you take, so I was just telling them, take a loan instead of a withdrawal.
Okay.
Because when you take a loan, the money that's getting invested is not. It's like you didn't take the money out. So let's say if I got 160,000, right, and I take 60,000 out as a loan, that 160,000 still stays in the account invested. So it's almost like you're not taking the money because the insurance company is thinking that you're going to pay it back.
Right.
But if you take a withdrawal and you take 60, so now it's only invested as the full 100.
Okay.
So you never really want to take a withdrawal. You want to take out a loan.
Okay. Yeah. All
right.
So let me ask you this question now. As far as using this as an investment vehicle, and we're borrowing against the loan.
Yeah.
From what I read, let's do some of the advantages of doing this. So some of the advantages of doing this is that, and you tell me if I'm wrong. If you do borrow against your loan, against your insurance policy, excuse me, not against your loan.
Take out the loan, yeah.
If you take out the loan against your insurance policy, one, they don't do any credit checks.
Is that because, well, it's your money, yeah. No credit check for that, yeah.
Okay, so think about it right now. If you wanted to invest, not invest. If you wanted to take out a loan, you could take out a loan based on face value of your cash value.
Based on the cash that you have.
I keep saying the cash that you accrued or whatever it is.
Exactly.
Okay, so the cash that you accrued, you could take out a loan against that, and you pay them
Yeah,
I
and it's
think
really
this is a good
yourself.
part.
So you paying yourself back interest because it's your policy. So you literally become the bank instead of going to Chase or to Wells Fargo and taking out a loan and they running your credit, and then you paying them back 12 or whatever percent interest. The interest that you take out of an insurance policy is obviously going to be much lower than the rate from an actual bank. So you take that money out, and when you put it back in, you paying yourself interest. So who would you rather pay back, yourself or the bank? It's a no-brainer. Yeah, exactly.
You know the answer for that. But hold on, guys. I see. Like I said, I keep it so straightforward, so real with you guys. That we give you everything straight up, and we are authentic. Come on in. See, that's how authentic we are. Go sit down. See, come on. We got a family inside here, so we got the host coming inside here, the superstar of the show, coming inside in a few seconds or whatever. So we're gonna go into the next part of it. So we're borrowing against the loan or whatever. So now if I want to borrow against the loan, hold on a second. I'm so sorry, guys. Don't worry about this. You can move the computer. You can move my bag. See how authentic we are? We keep it straight authentic. All right. So if I'm borrowing against it, there's no credit checks needed. And I could borrow against my money up until whatever the value is. Whatever the cash value is. So if I had, I'm giving an example. So I'm not going to do the math because I'm not good with math. But let's do the math right now. So if I had a loan that if I had a value of $100,000 or whatever, paid over whatever years.
Yeah.
So it's now $100,000. I can actually take that. I could take a loan against that value of $100,000, and then I pay myself. Wait, hold on. Is it tax? I mean, is there taxes on it? Okay,
no, it's tax free.
Yeah. Okay, so the money
you don't pay taxes on loans, so either way you'll be good.
I just want you to hear all this. Yeah. All right. So I'm not paying any tax on the money that I take from the insurance policy. So I'm taking out a loan, no credit check needed. I could take up to the face value of the loan. So if I wanted to do something like take money out to put money on a house.
Yeah, I discovered that you can do that. You could use it as a down payment for a house.
See, we're talking about building wealth here. So here goes we're gonna put all this together. We're gonna put little pieces together. So here goes the good part. You're gonna help me out with that. Yep. So you start off with how many loans? Why is it so important? It's so important because not only does it cover our families, but we can also borrow against it. Now, if we borrow against it, we're not paying no taxes on the money that we borrow. And there's no credit checks needed.
No credit checks. And the interest you're paying back is for yourself.
The interest I'm paying back is for myself, and I can make whatever payment, like as long as I'm making a payment on the money that I borrowed, my insurance still stays like the way it is. Stays active. So now that value may not be, you can't expect it to be, but that value may not be the same thing. But we could take that $100,000, put it on investment property, and watch that money make more money.
Exactly, and that's what I would recommend. That if you do take the money out, it should only be either for emergencies or for an investment purpose. So when you get that money back on the back end, you could put the money back into the account so it could continue to generate money and interest. So one of the things, you can't take the full amount. So if you got 160, you can't just wipe out 100. You still have to have some money into the account to let it grow and to let the insurance company
even
know
if
that.
It's half.
Yeah, even if it's half. Yeah,
even if it's half.
You can take out your cash value portion of it after the course of insurance accumulation. That usually takes about like maybe 7 years. So you can't just dump 100,000 in and then next week say, hey, let me borrow it. Like there's rules to it.
I was trying. Yeah. I tried. But this goes back into the importance of when we start.
Yeah.
We start as soon as possible. While you're young, you start doing all these things as soon as possible. So instead of touching like 401ks, I mean, you could actually touch forward, but we'll go into that whole nother subject. But we can touch that the same way we could touch a 401k or something else, where we could take it, borrow against it to make more money. We're generating wealth here. we're taking money that we paid for something that we invested, put aside. It gained interest, like you said.
Absolutely, yeah.
It gained, well, we said IUL.
IUL
where it
or
went
whole
according
life.
to-
You can
whole
do
life.
it too, but the interest is generally lower, but it's more stable.
Right. But it went according to the market. So we're assuming that we're going to get some sort of return, even if it's an 8% return, 5% return on our money that we didn't actually have to put extra into. So
Yeah.
we're getting whatever that value is, we're getting a little bit more money that we could borrow against,
Yep.
put it into something else
That makes you more money.
that makes us more money, and take that more money that we're making, take some of that money and pay off that loan at our leisure, kind of.
Absolutely, yeah. And I think there's also like a way in there where if you have enough, if your policy is big enough and you don't take, like there's probably maximums that you can take out, of course, but let's just say something happens and you're not able to pay that money back. The insurance company, and you, let's say you take out 50,000, for example, and you pass away, you're never able to put that back in. That just comes out of the death portion of the policy.
That comes out of the death portion of the
so-
policy.
so
Right. If you don't pay it back.
if you don't pay it back,
Okay.
if you were supposed to get 200 and you don't pay that back, then you're probably gonna get 150. Like you see the math. So
Okay, right.
So
No, I like the
But
math.
generally, if you can, you want to put the money back in.
All right, and usually the interest from what I read is anywhere from like 5 to 8%.
Yeah, correct.
Okay, so hey, can I point this out too real fast? As we saying with paying off debt, if you're withdrawing money, you could withdraw. Take a loan, not withdraw. Take a loan out. Take a loan out against your life insurance policy, and you could you could use that to pay off your credit card debt, which may be at 18 to 21%, and now you're paying 5 to 8% at your leisure.
Paying half of that, yeah. You slash your costs in half. You can do that as well. You just got to make sure, obviously, that you're in a position once you pay that off that you already have the income coming in where you can easily pay that money back.
Yeah, but think about it. Like, but here it goes. Let's think about it though. Let's think about it because, like I said, we're gonna get to the money part as far as building wealth. If you're borrowing against your insurance policy to take out money to pay off your debt, and your interest rate on your credit cards may be anywhere from 18 to 21%, depending on what you owe. You're paying close to 50. I'm just making up a number. You could be paying anywhere from $50 to $100 to $150 just in interest per month on your credit card. And you're now saying that I can take that loan, pay off my debt at a 5% interest rate, and pay back the loan kind of I'm not going to say on my leisure, but I could pay a little bit more each month. So instead of me paying 18 or 20, I'm paying 5 to 8%.
Yeah.
So the money that I save,
your pocket, yeah. Interest save is money back that you can save and do something else with it.
Awesome. You see how I'm learning a lot from you, brother? I appreciate that. Now that's good. So now he basically told you how you can do these things. So I guess that's where you was talking about the importance of starting early. Well, you said earlier, starting early. I remember that. Starting now, right now, ASAP. You're gonna have to put some time into the policy, so don't think that.
Yeah, it's not something you can go in and take money out overnight. There's obviously something called the cost of insurance, which the insurance carrier like spreads the risk out of all of the other policies that they own.
Okay.
So obviously, if everyone
started doing it at the same time, then they got them.
They add too much of a risk, and if you want to make sure that everyone gets paid on time, they have to do things accordingly. So they have obviously statisticians and stuff that run numbers and stuff. People that are smarter than me, of course, where they know.
You're doing a good job, bro.
This is
you doing a good job. You're smart. You doing a good job.
I know a little something.
You doing a good job.
But that's generally the basics. Is you can borrow against it. You can build your own bank if you're doing good. And there's certain limits, of course, because a lot of people back in the day, like people who were like high net worth individuals, used to take money and they used to just dump it into these policies. And obviously, because they know when they pull it out, it's tax free. So there's certain minimums that you can actually put into the policy each year before it becomes a MEC, which is a modified endowment contract. And if you put in over the maximum of what you're supposed to put based on how much the policy is worth, then you're going to have to start paying taxes on it. But your insurance agent or the actual company that you're working with is going to let you know, hey, listen, make sure every year you don't go over this number.
Man, you just hit me with a whole lot of information, and I'm not gonna lie to you. I probably will be rewinding this myself and going over it.
Write it
and
down and
definitely.
Google it.
Google it, right? Everything is Google
Everything
it now.
is Googleable.
Google it, right? So we want you guys to know that one, and we're saying the importance of it. Like, we don't want to make this boring. We don't want to have a boring show, but we're not going to be here to entertain you and speak about all these other stuff going on just for your entertainment or clickbait. We're all about you trying to build your wealth up within your family, whatever your wealth is. I mean, wealth has a different meaning to everybody. Wealth doesn't have to mean yachts and mansions. Wealth, it could be living day to day and not having to struggle. That could be wealth.
That could be wealth. Not going without or having to choose if you want to get this versus if you want to get that.
Right. Right. So
that could be what wealth stands for.
That could be what wealth stands for too. So, so the one thing that he said, and I'm taking away from, so I'm not gonna lie, is we putting away the selfishness. I just like summarize everything so everybody knows. So we have to put away our selfishness and start thinking about our kids and the next generation. Because if you think about it, I'm not going to name any families on here, or whatever else the case may be. But if you think about it, there's a lot of families out there that are passing down generational wealth, and they are way ahead of us. And if you want to speak about the gaps when it comes to wealth between some communities and other communities, this is the things that they're doing. So they're not out here playing around and going to consume everything in sight. Like, they're already thinking 5 steps ahead of all of us. Yeah. So while we're consuming their products, while we're buying all their materialistic items, and I'm going to say it like this, I'm sorry, I don't mean to say it like that, while we're trying to look fly and trying to impress the next person, they're making sure that their wealth is already built up and they have this sort of cash, and you can see how they are living in comparison to how you're living. And I don't know who you are, whatever else, but I only keep it real. And you'll notice that the sort of wealth that they have, their family is good, their sons and daughters is good, their grandchildren is good, and then their great-great-grandchildren is good, and we're right out here struggling, not knowing how to do certain things like this in order for us to get ahead. Because I'm not going to lie, I may look at a few of my insurance policies, and I'm not saying like that, but if I do come into certain things, I may look at one of my insurance policies and say, hey, you know what? I'm looking to turn this hobby into a business. Let me borrow against my insurance policy, and let me take out a few dollars. At least if I pay off my debt, I pay off my credit card debt, which is whatever percentage it is, 15 to 20, whatever they choose, however they choose to fluctuate it. I pay that off and say, all right, you know what? That money that I was paying in interest and payments to the credit card companies, I'll just give some of that money to the other guys, the insurance company. Pocket the other money. Now I have this 20,000, 50,000, 100,000, whatever it is. I have that where I can say, well, you know what? I'm going to go pay on this investment property. And the investment property was pay itself off. Yeah. And then I'm taking that money and maybe invest in another property, maybe invest in another business, or doing certain things like that. So that's where we're looking to get into our neighborhood. I mean, as far as in our neighborhood, this is what we're looking for you guys to get into. So like I said, we're not trying to be boring, but a lot of people don't explain certain things, and they don't. Excuse me, I'm away from the mic again. A lot of people don't explain certain things and how to get money. They just tell you that they have money, they're doing it, and
they don't go into depth of how you can do it. And if they do explain it to you, they ask you, you got to go behind the paywall or subscribe to this subscription where you got to charge them a monthly fee. And I don't think there's anything wrong with charging for information, but I think especially in our community, there got to be some resources where people could get game for free and not always have to come out of their pocket.
Right. You just said it. I can't even say nothing else after that. Yeah. You said it exactly. So this is exactly what we're looking for, and he will be with us permanently. He's gonna be here permanently doing all the financial stuff for me. I didn't really get into all my stock stuff, Will. So I'm sorry,
We'll
man.
cover that next.
We'll cover that next episode. But when we get into that, see, here goes the thing to it, and I want y'all to understand the basics to it. So I know Will understands it, but I want you to understand the basics to it. So think about what we just spoke about with insurance. I keep saying this because I'm trying to drill it into you guys. Think about what we think about with insurance. So if I took the money, if I took a loan from my insurance company, I took that money and I put it in a safe stock, maybe a mutual market, whatever. I'm not into that, so I don't know about that. But I put into mutual funds. I could put into, now I know about the stock business. So if I put into a safe stock or so forth and let it grow, or let it do what the market does or whatever, I could take that money and let that grow also. So I'm taking the money that I had on this side, taking it and borrowing it, making it grow on this side, while I'm taking my little coins and putting it back into the other side.
Absolutely.
So I'm making money right here while I'm paying my little coins right there, and I'm making that grow. So now I got money hopefully growing in two different places instead of just the one right there.
And that's what it is. That's how you really build wealth, of having multiple streams of income. So it's especially now with the way the economy is heading, even if you have a job or if you have a business, all wealthy people don't depend on one income. And initially they may depend on one source of income, but when they actually get to the point of real wealth, they spread their risk out. They may have real estate, they may have stocks, they may have obviously money from their own business. So in order to build wealth, you want to be able to diversify your risk and be able to invest in, whether you want to invest in gold or silver. So
Whatever it is.
And I want to cover in another episode of why saving is really not a good idea, especially now because of inflation. Okay. So there's no way in hell that you can save your money to save your way to wealth. You have to invest it.
Brother, I'm sorry. This guy's hitting me right now. He's hitting me right now. So I'm just dung. You know what I mean? I'm sorry. I didn't mean to say it like that. I like having fun with this, and it's not boring. But he's hitting me right now. So I'm glad that you said that too. You're right. You can't save your way to wealth. And it's about time that we start moving the pendulum in our favor. And start building this wealth and doing it right now for us, and not even just for us. It's not even just about us. It's for our families and our future generations. So, like I said, dumb money, smart moves. You know why we call it dumb money? We're calling it smart moves. That's because we're trying to give you smart moves.
Trying to cross on the other side. You can't be the dumb money for too long.
Can't be the dumb money for too long. Right. So remember, like, subscribe, leave a comment below. And we are actually going to come back with another episode. This is kind of like the entertainment part of everything. And we're going to bring on our other hosts. I don't want to say Queen Bee. She's my Queen Bee, but Q. You know what I mean? I don't like saying her whole name. She likes saying her whole name. But we're going to bring Q on, and we're going to get into some good stuff. But the next topic, just so everybody knows, so we want you, the reason why we want you to subscribe is because we always have these great topics. And as we go on, we're going to go much deeper into everything, where we actually talk about making money also along with everything. So we're teaching you the basics right now. So this is the basics. So the next thing we're going to start talking about is taxes, tax benefits, tax havens. We're just going to talk about the basics of it. We're not accountants, so we're not giving you financial advice.
This is not financial advice.
Not financial advice at all. So if we would like to say we don't know what we're talking about, so that's going to cover us. We don't know what we're talking about. Whatever disclaimers we need to add to it that goes along with it, put that on with it or whatever. We're not financial advisors. We could call us dumb if you want to call us dumb. We're just giving you some information. You use it or you don't use it. Kind of, I'm not going to say it doesn't matter to us. We hope that you benefit from something. Take it up and look it up. Do your own diligence, right?
Always, that's all. Whatever anybody tell you, never take anyone's word for face value. Always look it up and find out if it's true or not, especially if the person that's giving you information has a financial gain behind it. Then sometimes it might be less reasons for them to be actually genuine with you. See, I'm not selling you anything, so there's no reason for me to try to, you know, tell you a lie. But even with myself, I would still look up everything that I'm saying to confirm.
Okay, cool. So this is Will. I'm P. You just watched Dumb Money, Dumb Money,
Money,
Dumb Money,
moves.
Smart Moves. We'll see you in the next one. Thank you for watching.
Thank you.